Since the government's first budget last October, everything seems to have become a bit worse. Growth forecasts have been downgraded from 2% to just 1% this year. Gilt yields are up, inflation will rise later in the year, and interest rates are still higher than expected. Government debt constantly rises more than past projections. For all the talk of meeting fiscal targets, they seem to get broken anyway. The only thing going down is real income, with some forecasting a 3% fall in after-housing cost income by the end of the decade. With gilt yields rising to the highest level since the financial crisis, government debt interest payments have risen by $10 billion a year, wiping out the Chancellor's very small fiscal headroom. This has led to rather frantic efforts to find savings, which have fallen mainly on sickness and incapacity benefits. It is estimated that tightening the criteria for personal independence payment will save an estimated $3.9 billion, affecting 800,000 people with an average £4,900 loss a year. Just last week it was hoped that these cuts would save $5 billion, but the OBR disagreed. And this is one problem with benefit reforms, as the OBR notes they often save less than the government hopes. As a result of the OBR's downgrade, the government had to find additional cuts. As the IFS note, after frantic government cuts, fiscal headroom in 2029 to 30 is exactly $9.9 billion, the same figure as last October. It does give the impression welfare cuts have been driven by the need to meet these twice-yearly forecasts, rather than careful long-term reforms to fix a broken labour market. One motivation for welfare cuts is that in recent years, higher spending on welfare and disability benefits have increased a lot, and they are forecast to keep rising. Since COVID, much greater rates of sickness, and this has led to much higher welfare payments. Previously, there was a very big gap between being income from incapacity benefits and just universal credit. The reforms will reduce this gap quite a bit, but it does come at a cost. The Department for Work and Pensions' own self-assessment say that these benefit cuts will cause an extra 250,000 people, including 50,000 children, to move into relative poverty. The Joseph Rowntree Foundation states that one family where one person cares for another could see an estimated £860 a month loss. That's 55% of their average disposable income. The Resolution Foundation predict the biggest losers of these welfare changes will be the poorest half of the income distribution. Ironically, it's very similar to the impact of means testing winter fuel allowance, not the very poorest, but those just above the bottom 10-20%. And so far, the OBR have not been able to model whether welfare cuts will actually increase employment. Yet, despite these spending cuts, the tax burden will continue to rise to a historical level, lower than many of the European countries, but still high by UK standards. Now, it's not technically austerity. Overall, government spending is rising. There's a kind of a net fiscal stimulus, although really quite small. But as usual, those unprotected departments, which have seen many years of cuts to spending, will see further pressure. Also, whilst it's easy to pencil in broad cuts to services, in the June spending review, ministers will actually have to find out how to implement these cuts on already stretched frontline services. Like previous governments, spending is front-loaded, which means that next financial year spending will rise by 2.5%, but by 2028-29 it will increase by just 1%. And it is worth pointing out that these modest rises in day-to-day spending is more generous than the previous Conservative government's plans, but still unprotected departments will see per capita cuts by the end of the Parliament. But the really big headache for the Chancellor is that after all this pain of cutting welfare benefits, it's quite possible that come next October, it will be Groundhog Day again, with a very small fiscal headroom being wiped out again. Why does it seem such an impossible task at the moment? Well, in a way, the Chancellor has boxed herself in by her own fiscal rules and then giving herself very limited leeway for things to go wrong. When you sail very close to the wind, it's very easy for global events to knock you off track. The US-inspired tariff war has already roiled markets, causing part of it rising gilt yields. It's not just the UK seeing higher interest costs. And when you have a national debt of £2.8 trillion, even a small rise in interest rates mean significantly higher debt interest payments, a really big share of government spending now. By the way, it was a shame in that area of very low interest rates, the government didn't sell more long-term bonds to kind of lock in that very low interest rates. There's also a missed opportunity for investment in public investment when it was so cheap to borrow. But anyway, that's kind of in the past. But it does remain an inconvenient fact that the Chancellor's quite small fiscal reserves were largely wiped out by a £10 billion rise in interest costs. But there easily could be more bad news in the coming year. For example, 50% tariff between the US and the rest of the world. If that was implemented, the OBR estimates this would reduce UK GDP by 1% and eliminate the fiscal headspace. Just yesterday, President Trump announced a 25% tariffs on car imports. Bad news for the UK car industry. Basically, a trade war could wipe out again this 9.9 billion headspace and its very fine margins. And what would happen if there's a really big financial shock or US economy slips into recession? Who knows? There also could be more reasons to be nervous about the future budget. I've often shown this graph, which shows that the OBR forecasts for productivity have nearly always been overly optimistic. They predict that productivity will rise, but then it never does. And with unerring predictability, the OBR have once again downgraded their productivity growth forecasts from just last October. They even put a new line on called scenarios, i.e. even we don't really believe productivity will finally increase. But the important thing is that if the growth forecasts do fail to materialise, output would be 3.2% lower and the current budget would be 1.4% higher. That's a big problem. Now, on the positive side, and yes, there is a positive side, the OBR have downgraded this year's forecast, but they say it will pick up later in the decade, i.e. growth delayed rather than not occurring at all. But after 15 years of disappointing growth, it may be one of those things that you will say, I'll believe it when I see it. It is really turned out to be a difficult decade ever since COVID at the start of the decade. So far, we've had the worst period of living standards growth since the 1920s. Now, on the positive side, you could say the budget points to areas which might increase growth. The OBR do believe that planning reforms and higher house building would have a really significant effect on boosting GDP and tax revenues. A crackdown on tax evasion, not much media coverage, but it is actually quite meaningful and could raise maybe £1 billion. Tax receipts from stamp duty are forecast to soar. Stamp duty is a way to get tax from more wealthy home owners. Some may well like to go more direct with a wealth tax, but that doesn't seem to be on the government's radar. And public sector investment is just about increasing. But whilst planning reforms may well increase the supply of housing, it will actually do very little to reduce house prices. The OBR suggests just 0.8% lower as a result of more building. And in fact, in modelling predicted future household income, the OBR state that 75% of extra income from housing services is actually a result of higher imputed rent, i.e. because renting is more expensive. They're saying that homeowners theoretically are better off because they're saving money paying rent, but try to use that logic when paying your mortgage. I don't think banks would accept it. Another inconvenient truth is that hidden in the budget is a realisation of how much the Treasury is making cash transfers to the Bank of England to pay for the losses of quantitative easing. The Bank of England is definitely not helping the government at the moment. Interest rates are the highest in the advanced world, especially for the state of the economy. Very low growth in the UK, of course. Also, the bank have been reversing quantitative easing, which means selling £300 billion of bonds back onto the market. And this has definitely pushed up gilt yields to some extent, meaning that interest rate costs have gone up. One option, by the way, to raise money instead of welfare cuts would have been tiered reserves, taxing bank profits from quantitative easing. Spreading the pain from the disabled and poor to profitable banks may even have been popular with the public, but what do I know about politics? Anyway, there are other innumerable ways that you could have done to raise the shortfall. For example, extending the freezing of the threshold for national insurance and income tax for 1 year would have raised close to £10 billion, and that impact would have been more spread across the population. But a bigger question is, for all this fudging of departmental spending and welfare cuts, what about the bigger picture? Is the UK actually really broke? Because in a way, the Chancellor is hemmed in by her own rules and very small margins which she left herself, and it creates this constant 6-month drama to meet the rules and fudge spending limits and things like that. And that does create uncertainty, which is a big drag on UK investment and consumer spending at the moment. I mean, actually, consumer savings has increased quite a lot. There's a lot of pessimism, which is causing people to hold back. Also, despite the rising gilt yields, this doesn't indicate some kind of Liz Truss moment. There's actually quite big appetite for buying UK debt at the moment. If anything, with US debt looking slightly less attractive, it might actually help the UK and other European bonds. But whilst I would like to say don't worry about the debt at all, another inconvenient fact is that the UK faces a lot of long-term challenges. Ageing population, global warming, energy transition, all going to be quite expensive. And this video goes into more detail about some of the rather scary projections for long-term debt in the UK, and it's going to be a real headache for whoever's in power. So, difficult time to be a Chancellor. Kind of glad I'm not in her shoes, but even so, some slightly strange decisions. But anyway, let me know what you think, and do subscribe if you find these videos useful. Thank you.